The world economy we live in today is very different from the one we knew only a few years ago, as we've been talking about on this program today. It sure would be nice to have a map for navigating our way through it, and that's exactly what a group of investors, policymakers, and scholars are trying to draw up. We're joined now by one of the project's chief cartographers, so to speak, Ellis, Managing Director and Chief Investment Officer at the Linn Group. So, if you could, Lincoln, in one sentence, explain exactly what we're talking about here. What kind of map are we talking about, and then walk us through it?
Sure. I mean, the idea behind mapping the new world economy came out of a series of conversations between myself and New America Foundation Program Director Cheryl Schweninger. And the idea was that the narratives that we were getting out of both Washington and out of Wall Street were too simple. They were too one-dimensional. And that post the Great Recession, we really needed a more dynamic map to understand what kind of changes had really occurred. And as you heard in your session just now with David, focusing on pieces like debt and energy, China, commodities, are multifaceted and very dynamic, and we need to think about them in new ways.
I mean, and sovereign debt is a big part of this, isn't it?
Yeah, it is.
I mean, what specifically? I mean, there's definitely imbalances if you look around the world when it comes to sovereign debt. I mean, the U.S. itself is looking at, a potential crisis situation in terms of dealing with its debt. How does that kind of factor into your thinking and what you guys are looking at?
Sure. So in a week's time, actually, Carmen Reinhart, who wrote This Time It Is Different with Ken Rogoff, now at Peterson, will be walking us through her assumptions on the global debt situation, and that too is a more multifaceted conversation than policymakers in D.C. would have us think. Not only are debt levels high, but creditworthy borrowers are evaporating.
And we're putting up a map for our viewers. I mean, these are kind of the hot spots, correct, when it comes to debt situations?
Europe, Japan, and the U.S. But of course, the situation is more fluid and more dynamic than that, right? The sovereign debt crisis in Europe is about sovereign debt levels, but it's also about where that debt rests, right? It rests inside private banking institutions. So you have a dynamic there that you have to unpack and understand both the ramifications for investors, but also for policymakers as well.
So, but the idea here is that this time it really is different, right? Because someone once said that this time is different are the four most expensive words in the English language. Do you think that's the case?
Yes, as I watched equity markets return 100% for the last 2 years, right?
Right.
Apparently not different.
Apparently not so different. But we do think, actually, and markets have begun behaving in ways, interestingly, that do reflect symptoms of 2008. But there are different dynamics. There are new pieces emerging in the emerging economies, and that sets up a dynamic, right? Additional consumption? Sure. But guess what? Savings rates are also rising faster than the consumption rates. So you still have ebbs and flows, and the assumptions can't be unilateral and linear.
What about, though, the imbalances, Lincoln, of debt loads potentially between developed and emerging economies and all that? I mean, how do those imbalances create some problems in your view?
They do create problems, but they also create opportunities, right? They create opportunities for emerging economies to themselves become debt issuers. But again, we run into this problem of creditworthy borrowers, and increased savings rates really set up a place where money has very few places actually to go.
Let me just ask, while we have you here, your take on the problems that we're having here with our $14 trillion of debt starting to look more and more like countries that we're concerned about, right? 100% of GDP are getting close to that,
right?
Does that mean that we're being added to this group here that we all have been concerned about over the last couple of years? Are we headed there inevitably?
We hope that we're not headed there inevitably, but we do hope that policymakers are thoughtful about conversations both about the debt ceiling and about spending. And, the president's...
What debt ceiling? They raise it every time we run into it, right?
Well, we
Might
will
as well not be there.
And we hope that we do.
I mean, do you feel like it's a real conversation now? I mean, I'm certainly skeptical, but I mean, in terms of what's going on in Washington, do you feel like there is a true conversation? They realize we've got to start doing something constructive and longer term.
I think you will know very quickly, probably over the course of the next 6 weeks, whether or not the conversation is becomes cynical or is actually sustainable.
Because of what? The debt ceiling debate?
Because of the debt ceiling debate. And that will push into the forefront an entire host of issues that have to do with liquidity in the markets, capitalization of our own financial institutions. Remember, JP Morgan writing off another $2 billion just this quarter.
All right, Lincoln, thanks so much for joining us. Lincoln Ellis here from the Linn Group. We're going to take a quick break.